It's official! Interest rates are in the sixes. But what does that really mean for you? If you've been on the fence about buying a home, you're probably wondering how mortgage rates actually affect your monthly payment. Well, look no further. This is Interest Rates Explained. Over the past 2 years, we have seen some absolutely unprecedented events in the real estate market. We have seen the lowest interest rates ever recorded in history, and now we are seeing rates come up to a still less than normal level. But people are still freaking out, and I totally get it. All of these news stories can be a little scary, especially because of how significant an investment it is to buy a home at these prices. Let's demystify what interest rates are first, and then we can go a little deeper on what that could mean for you. When you get a mortgage, you take out a loan. Unless you have hundreds of thousands of dollars in cash laying around, almost everyone takes out a mortgage. Interest rates are the cost of borrowing the money to purchase your home. Every month, your mortgage payment will consist of principal reduction and interest. Principal reduction is building equity. It's bringing you closer to owning that property free and clear and paying off that loan altogether. Although you are paying off interest every month, the beauty of a mortgage is your monthly payment doesn't change every year. You locked in on how much you are going to pay as opposed to rent, which is 100% interest. Let me say that again. Rent is 100% interest. And that payment absolutely can and does change every year, or sometimes even more frequently, depending on your lease. So speaking of interest rates, what happens when the Fed raises them? Why do they raise interest rates? We are going to get a little nerdy for a second here, but stick with me. Interest rates are raised or lowered to balance the cost of goods. Now, if you've been at the gas pump lately, you know what I'm talking about when I say the cost of goods is going up. And don't get me started about how much a gallon of milk costs these days. This is inflation. Inflation is what the Fed tries to curb by raising interest rates. The Fed is a short way of saying the Federal Reserve. These are the people that try to keep the economy from collapsing. Now, if you're already in a mortgage, interest rates don't necessarily affect you. But if you're looking to purchase, this is the rate that you could be locking in your mortgage payments at. So what do we do when interest rates are rising? For every 1% mortgage rates increase, buyers can potentially lose up to 10% of their purchasing power. This can price some people out of homes and neighborhoods due to how much money they can qualify for. And this is where we come in. There are so many different ways to lock in a lower monthly payment, even when interest rates are up. One of these ways is through an adjustable rate mortgage, commonly referred to as an ARM. Now, for those of you who owned a home in 2008 or even heard about an ARMs, then let me tell you, today's ARM mortgage is different than the ARMs of the past. In the early 2000s, lending was kind of a lawless place. Somebody making $10 an hour were qualifying for homes that over twice of what they could afford. These mortgages also had some really risky features like prepayment penalties and no cap on adjustments. We have learned our lesson from 2008. That was then. This is 2022. Those risky features are gone now, and the housing market is completely different than it was back in 2008. An adjustable rate mortgage means that as the interest rate that you pay on your monthly payment changes after a set period of time. Typically, it's 5 to 7 years before the interest rate that you locked in actually adjusts. ARMs are classified by two numbers. So you'll often hear, I got a 7-1 ARM, or I have a 5-1 ARM. The top number refers to the number of years your original rate stays the same. The bottom number refers to how often your rate will adjust after that time period, and most ARMs have a cap on how much it can adjust, usually around 1%. A realtor friend of mine was actually able to lock in a 2% interest rate while the interest rates were 4 or 5% at the time, with a 2% cap on adjustment, meaning that he'll never pay more than a 4% mortgage in 6 years. This is important to know because the average amount of time most people stay in a home is 7 years. If you're planning to stay in your home forever, this might not be the best solution for you. But for many people, this allows them to save a lot of money and live in a home that works for them. All right, here's a real simple graph, one that you can do yourself. Now, you have two choices here in America, right? You have rent, okay, or what? Buy. And here are your two choices. Now, it gets real simple when you look at the foundations of real estate and what choices you can make. So we all have the same time, right? All over the same time. And especially in shifting markets, there is one metric that always goes up, right? Rent versus buy. And what that is for rent is we all have a purple line. So here is a purple line. For rent, your payments go up over time. So over here on buy, instead of payments, what you have is equity. So we've all learned what equity means now. So equity is wealth, payments is a liability. So rent versus buy over time, this applies all across the board. You get to choose rent buy, whether your payments go up or your equity and your wealth goes up. I just want to put one thing in perspective right for you guys right now. When you weigh real estate with other kinds of investments that have interest rates attached, it really helps us see what the true cost of investing is. The average credit card interest rate is 17% right now, 17%. Auto loans average rate is 9%, and that is a depreciating asset. When we start looking at the interest rates for homes, doesn't that put things a little bit more into perspective, make you feel a little better? And what other investment do you actually get to live in as well? And you gotta live somewhere. Guys, we have so many tools in our tool belts that can help you. If an ARM doesn't sound like a good solution for you, we have so many different and creative ways to help you. As always, thank you so much for watching. If you have any questions, please click the link in the description and we will reach out to you right away. And I'll catch you on the next one.